Natural gas traded in a choppy range this week, anchored near the $3 level, a price point with strong historical relevance as both support and resistance over the past 2 years. This consolidation zone is technically significant. On a longer-term view, the 20-month chart shows a potential large-scale head and shoulders formation, with a projected breakdown target near $2.50. A decisive move below this week's low would likely confirm that pattern and accelerate downside momentum. Conversely, a break above this week's high would imply continued range-bound trade into the early winter pricing cycle. Fundamentally, the market remains in a transitional period. Seasonally, August and September are not strong demand months for natural gas, but futures pricing tends to begin factoring in winter heating demand by late September. This year, structural demand shifts add complexity. The EU is committed to $250 billion in annual U.S. energy purchases for the next 3 years, displacing Russian gas imports. This raises the possibility of Russian supply being redirected to price-sensitive markets, potentially reshaping global trade flows and competitive pricing for U.S. exporters. In the short term, weather patterns have offered limited bullish catalysts. U.S. summer temperatures have been above average but not extreme, resulting in only modest electricity demand growth. Moreover, if economic activity slows into recession territory, industrial and power generation demand for gas could weaken further. Overall, the $3 pivot remains the key battleground. The market's next directional signal will likely come from how price interacts with the boundaries of this week's candlestick, setting the tone for whether the head and shoulders pattern plays out or the market stabilizes ahead of winter. Crude oil prices remain choppy, with WTI initially pulling back in early Friday trade before stabilizing. The immediate technical focus is on the $65 level. A sustained break above this threshold could open a move toward the 50-day MA at $68, and potentially the resistance near $70. Geopolitical risk is adding to market volatility. Donald Trump has reiterated threats of sanctions on Russian oil, with Friday marking his stated deadline for a Ukraine ceasefire, an event that could alter supply sentiment depending on the outcome. From a chart perspective, prices are approaching a prior consolidation zone, which may provide a technical base for a rebound even in the absence of a clear geopolitical catalyst. This confluence of technical levels and headline risk suggests the next directional move will be driven by whether buyers can re-establish control above $65. Don't forget to like, drop a comment, and check out the previous video to help support the channel. See you in the next one.